Hey traders, welcome back to my YouTube channel. Today in this video, I will teach you what is liquidity and why it is so much necessary for trading. So, first of all, what is liquidity? Liquidity is nothing but market orders, buy and sell orders. So, the market buy and sell orders is known as liquidity, meaning every candle high and every candle low has a liquidity. No matter if it is green candle or it is a red candle. So every candle high has a liquidity, every candle low has a liquidity on the wicks. Okay, above every bullish candle has a buy side liquidity and every bearish candle below has a sell side liquidity. Why? Let's suppose you took a trade and you took a short position and you open a sell order, and now you will place a stop loss, right? So you will place a stop loss where? Above the swing high. So to exit your position you will open a buy order. So that's why every swing high has a buy side liquidity, or we also call it buy stops, and every swing low you open a long position and you will place stop loss below that low. So you open a sell order, so every swing low has a sell side liquidity and every swing high has a buy side liquidity. All right, now liquidity is all over in the market, everywhere in the market. As I told you, every candle high has a liquidity, every candle low has a liquidity. It is non-stop everywhere, back and forth continuously, but it is super important for us, because if you do not understand liquidity, you will always take early entry, late entries, you will do over trading. Basically you will trade randomly and you cannot find your edge. So liquidity is very important. It is like a fuel of the market. Market needs fuel from one point to go another point. It needs liquidity, it needs orders, buy sell orders. In the end it is a transaction. So no transaction, no market movement. Market moves because of the transactions. So now there are two types of liquidity, as we understand: buy side liquidity, sell side liquidity. Now there is two type of liquidity: external liquidity and internal liquidity. All right, so what is this and why it is very important? So every major swing point has an external liquidity, like this, like this, like this, like this. Again, sell side liquidity, buy side, sell side, buy side, sell side, buy side. And every internal low and internal high has an internal liquidity. Means if we are trading in a range between swing low and swing high and we have this market structure, it means this is internal liquidity. Why it is internal liquidity? Because it is between the range. Okay, so identifying external liquidity is very easy, because you will find major points. Like, let me show you gold chart. This is gold and this is daily chart. Let's remove these indicators. Okay, so this is the gold chart. Let me remove the alert. So this is the trend. Okay, so here we are bullish, we was bullish. So where is our external liquidity? This. Now this is in the range, so this is our internal liquidity. Let me draw with the arrow. So you will find external liquidity, internal liquidity, external liquidity, external. So whatever you seeing, the origins, the major points which is clearly visible, is known as external liquidity. And whatever is happening between these, this is internal, all internal. So most of the times price stuck in a range, and you will get trades between internal liquidity and not in external liquidity. This is sad, otherwise everyone would have made money if trading was so simple. So for example, this was our gold range. Okay, so this is external liquidity, this is external liquidity. Price took out external liquidity, means sell side liquidity. Now what is gold doing? Sideways. So whatever is happening between this range is our internal liquidity. Okay, so every time whenever price took or grab any liquidity, let's say price grab buy side liquidity, it will give a pullback. Price give buy side liquidity, it will give a pullback. Price took sell side liquidity, it will give a pullback. Buy side, pullback. Why this happen? Whenever price grab any liquidity, it will retrace because of the transactions. The transactions are happening at that place. The traders are taking entry. Breakout traders are getting trapped on these points, and market create liquidity on these points. So market does two things only: engineering liquidity when price becomes sideways, and then manipulate, and then give expansion, and then again repeating same process. Liquidity is just a fancy word. It is an old concept which came from Wyckoff. Most of you knows what is Wyckoff. So Wyckoff call it redistribution and reaccumulation. Means whenever we are down and price grab buy side liquidity, it is redistribution. Means you should not look for buys, in fact you should look for sells. Why? Because the flow is already bearish. Now liquidity and break of structure looks similar, that's why trading is tough. If this happened, now you don't know is this a breakout or liquidity grab. So for that you need proper context, proper story, and proper narrative from top down analysis to build your bias. But that was not the topic of the video. Today topic is only liquidity. So one thing to keep in mind always, whenever you look for buy trade, again listen this carefully, this will massively increase your win rate. Whenever you will look for buy trade, you will wait for sell side liquidity sweep first, then you will plan your entry. Whenever you look for sell trade, you will wait for buy side liquidity sweep first, then you plan your entry. Why? Because price was falling, people took their sell position here, they placed their buy stops here. Then what market maker did? They grab their liquidity. Why they grab their liquidity? Because their orders are huge, they need liquidity, and they are not taking your $1 or $10 $100 liquidity, they are taking other market makers liquidity. So that's how market moves. And then they grab the liquidity. Don't say market manipulated me. Market is not manipulating you. Your $10 does not matter. Fuck off. So price grab buy side liquidity, and then because you know the rule, whenever you will take entry, you will take after the liquidity sweep, then you plan your entry, and then price gone into your favor. So here is the key rule: whenever you will buy, you will wait for sell side liquidity to sweep. Whenever you will sell, you will wait for buy side liquidity to sweep. Alright, so what we learned today: what is liquidity? Let's summarize this. Liquidity is market orders, buy and sell orders, transactions, and it is everywhere. You need proper context understanding to identify what is your drawn liquidity, what is your objectives, and what area will get liquidate, sweeps, all of that. You just cannot trade liquidity blindly. You also need proper understanding of market structure and supply and demand. All right. Second thing we learned: what is external liquidity, what is internal liquidity. Whatever the major swing points are external, and whatever the stuck between these swing points is our internal liquidity. Whenever price took liquidity, pull back, liquidity, pull back, liquidity, pull back, liquidity, pull back. All right. And third thing, whenever you will look for buy, you will wait for sell side liquidity to sweep, and whenever you are selling, you will wait for buy side liquidity to sweep. Alright, so if you like the video, please subscribe and comment and tell me on what topic I should make the next video. And forgive me for my English because I am from India, it is not my first language, but I hope you understand my points. So thank you for watching.